If you don't know where you're going, any road will get you there. An income statement is a financial statement that provides information about a business's revenue, expenses, and profits or losses for a specific period. By analyzing the income statement, businesses can track their financial progress and growth over time. In this video, we'll discuss how to use the income statement to track financial progress and growth. Let's begin with revenue. Tracking revenue is an essential component of income statement analysis. By comparing revenue over time, businesses can assess their sales growth, market share, and customer demand. A business can also use revenue to analyze the performance of specific product lines or services, identify customer trends, and determine the effectiveness of their pricing strategy. For example, a business may track the revenue generated from a specific product line and compare it to revenue generated by the other product lines. By doing so, they can determine which products are driving revenue growth and identify any product lines that may be underperforming. Second, gross profit margin. Gross profit margin is the percentage of revenue that remains after deducting COGS. By tracking changes in gross profit margin, businesses can assess their ability to generate profits and identify any inefficiencies in the production process. For example, if a business's gross profit margin is decreasing over time, they may need to look into the cost of goods sold and identify ways to reduce costs without sacrificing quality. They may also need to analyze their pricing strategy and determine if their products or services are priced appropriately. Third, operating expenses. Operating expenses, as we have discussed earlier, are indirect costs associated with running a business, such as rent, salaries, and utilities. By tracking changes in operating expenses, businesses can assess their efficiency in managing their costs and identify areas where they can reduce expenses. For example, a business may track their operating expenses and compare them to industry benchmarks to determine if they are overspending on certain items. They may also analyze the expenses to determine if they are investing in the right areas, such as marketing or research and development. Fourth, net profit margin. Net profit margin is the percentage of revenue that remains after deducting all expenses. By tracking changes in net profit margin over time, businesses can assess their profitability and identify areas where they can improve their financial performance. For example, a business may track the net profit margin and compare it to industry benchmarks or competitors to determine how they are performing in the market. They may also analyze their net profit margin to determine if they are making enough profit to reinvest in their business or pay out dividends to shareholders. And finally, and fifth, cash flow. While not a component of the income statement itself, tracking cash flow is an essential part of financial analysis. Cash flow refers to the moment of cash in and out of business, and it is critical of a business liquidity and ability to operate. By analyzing their cash flow statement, businesses can assess their ability to generate cash, pay bills, and invest in any growth opportunities. For example, a business may track their cash flow to determine if they have enough cash on hand to cover their expenses and invest in growth opportunities. They may also analyze their cash flow to determine if they need to adjust their operations to generate more cash or reduce expenses. Overall, analyzing the income statement and tracking financial progress and growth over time is a critical part of financial management for any business. By monitoring revenue, gross profit margin, operating expenses, net profit margins, and cash flow, businesses can make informed decisions about their operations and investment, set goals, and measure their progress. Let's take an example of a software company that has been in business for 5 years. The company's income statement shows a steady increase in revenue, gross profit margin, and net profit margin over a period of time. The company's operating expenses have remained relatively stable over time, indicating efficient cost management. Based on the income statement analysis, the company can conclude it is making steady financial progress and is on track for growth. To use income statement to track financial progress and growth, business should regularly review and analyze their income statement. In conclusion, income statement is a valuable tool for businesses to track their financial progress and growth over time. By monitoring changes in all the elements that which we have discussed, businesses can assess their financial performance, identify areas for improvement, and make informed decisions about their operations and investment. As Lewis Carroll said, if you don't know where you're going, any road will take you there. By using the income statement to track financial progress and growth, businesses can stay on the right path towards achieving their financial goals.